Hi guys, and welcome to Symax Fintech Weekly Insights. First of all, our disclaimer. So obviously trading involves the risk of loss of capital. It's not suitable for everyone. Hopefully it is for you. As many companies provide leverage, just be aware you can lose substantially more than that initial investment you make. These days there are more safeguards, such as the brokers don't allow negative accounts, and that's because of new regulations. But it varies from country to country, broker to broker, so be careful there. All the views, opinions, everything involved in this basically are mine, Chris Tubby, and they're just for educational purposes, and we are not encouraging you to invest or trade. That has to be your decision. But you should carefully consider the risks, your financial situation, definitely your level of experience, your risk appetite, and of course you should only risk capital that you're prepared, but more importantly, that you can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you risk your capital. Okay, so first thing we're going to look at is what happened last week. So PCE came in year on year 4.6. PCE is one of the key indicators and pieces of data that the Fed look at. GDP, yeah, the US is in a technical recession, but their data apart from that is still really good. And the rates are going up still, without a doubt. And of course, at some stage, then that's going to become more than a technical recession. But I shall discuss that in a little while. PMI was weaker, consumer sentiment was higher though. So again, you're still getting these mixed signals from the States. Durable goods was okay, nothing special, but it was okay. And that's more coming from the commercial sector we're buying rather than the consumers. And then, of course, the thing that we was all pretty much had our eyes on at the end of the week, which was Jackson Hole Symposium and Powell's speech, which was short and definitely not so sweet. I'm going to cover that in a minute. And China trimmed their rate very slightly to 3.65%. That's still on this easing program at the moment, which is interesting because usually their rates are much higher than pretty much the rest of the world, especially Europe and the US. But that's going to look as though they're going to become equal, or possibly even they're a little bit lower than the US, possibly the UK. Not so sure about Europe. Europe PMI levels ease slightly below 50. Below 50 is negative for the economy. Above 50 is growth. But, it's really, unless it gets down to that 44, 43%, that sort of really is indicating recession, contraction type data. And of course, the ECB minutes confirmed that they will fight inflation. And traders now expect more rate hikes for them. Possibly they'll be that little bit more aggressive now. They're back into neutral territory, looking for them to go positive with rates. Stocks, Powell finally spooked investors, woke them up to what's really going on. And they dropped about 3% on Friday, as you'll see with the charts when I show them later. Oil was lower on expectations that potentially Iran may begin exports again soon. But again, that could possibly be countered by OPEC, although they've been pressured and they've increased production, which to be honest, they struggle to meet their quotas still. They may decide that if prices start to drop too quickly, that they may start to cut production again. We'll have to wait and see. Gold weighted the week really to get some moves, but it just failed, and pretty much back to where it started, which is 1750-ish. The USD came under a little bit of pressure at the beginning of the week, but after Powell's speech, it strengthened back up again with that expectation of more higher rate increases. So the dollar finished the week strong. When we look forward to this week, of course, Friday we've got NFP, non-farm payroll, unemployment in the US, so we're looking forward to that as always. And of course, there's lots of Fed speakers as well, so just be aware what times they're speaking because they will impact the markets. Consumer confidence. Now, for me, consumer confidence is an underrated piece of data. It's a 3 o'clock data. In the US, sort of like the biggest data they put down at 1:30. So it really sort of irks me a little bit sometimes that the consumer confidence is a 3 o'clock figure. Because for me, we account for 70% roughly of an economy. So surely what we're doing and how confident we are of our, short-term, long-term future prospects for earning is going to impact the economy. So I really don't understand why that's not taken a little bit more seriously, shall we say. And then we've got PMI manufacturing. It's expected around 53, which again, it's still positive. It's good data. ISM, construction spending, and auto sales. And again, auto sales, home sales, you would expect them to be reducing because we're in that point now where interest rates are going up and people are going to be more wary of making these big purchases. But also when it comes to auto sales, there's it's very high debt levels now. I think it's something like about $1.7 trillion. And of course, if it becomes more and more expensive to service that debt, that's when you're going to start to see more and more defaults coming through in that area. Now, in the UK, we've got manufacturing, PMI. In the EU, we've got CPI. And of course, that's going to be around about 9.2% with core inflation, around about 4.1%. Again, the core just takes out some of the more variables. Unemployment, business sentiment, PMI manufacturing, and again, consumer sentiment coming out in the EU. And in Asia, China's got their PMI manufacturing coming out as well, so keep an eye on that. Okay, the macro outlook. So has it really changed? To a degree, I think it has. Inflation. We're not going to escape inflation, especially in Europe, around the world at the moment, especially by this war's going on between Russia and Ukraine. And that is having a massive impact, and Putin's using that as an economic weapon against the world, but specifically Europe. And to be honest, it's working because just look at our inflation levels. And of course, with central banks determined to bring inflation down, they're just going to keep putting rates higher and higher for the moment. There's going to be a time where they're going to have to stop, or they're going to have to take a second look at what's going on with the economy. So, they may have to put a breaker in at some stage and then have a little bit more of a wait and see what impact their actions are eventually going to have on the market. But for me personally, I believe recession's around the corner. And I think that the central banks are really inducing them. They are going to orchestrate demand destruction. They fear inflation more than they do recessions. So rates will continue to rise, and not only just rise, but don't expect them to be reversed very quickly, not when you listen to Powell. They're going to remain there longer until inflation is beaten, and they're convinced that inflation is beaten. But then, you've got to look at the drivers of inflation. Okay, so, we've got these supply chain issues, but they are improving. China lockdowns sort of stop-start there, but they do have an increase in cases. So we'll have to sort of just expect China to do what they will there. But again, that could have an impact moving forward on supply. So, just keep an eye on that. The Russian invasion of Ukraine, as I mentioned, is now 6 months. You know, it just still seems that stalemate, a little bit of give and take, but obviously, you know, when it comes to energy and food inflation, you know, food prices have been up, they've been down, they're steady at the moment, but again, you know, sort of weather is impacting it slightly. But Russia controls the gas flow. You know, there's no doubt in that. And Putin's turned the gas off, and you know he puts it down to maintenance, but he's just demonstrating that he's got control over that. And unfortunately, you know, the actions of the politicians introducing sanctions. You know, I'm not saying sanctions are wrong, but they've really backfired because what have they done with Putin having that ability to punish Europe, especially with having to pay extremely high gas prices and energy prices in general, that is having a massive economic impact, and it's us, the consumers, that are paying the price for that. You know, in Europe, especially in the UK, we're going to see millions more people placed into energy poverty for sure. You know, people are going to, especially as you come into winter, are going to have to choose. You know, do we feed the family? Do we have the lights on? Can we have the heating on? There's going to be big decisions to be made there. And, you know, it's going to be a problem and for industry as well, because if Putin decides just to leave that switch turned off over winter, you know, Europe and industry are going to go through blackouts. They're going to go through times of non-production. And it's going to be interesting to see how the governments manage that and handle that. You know, it's not that you can just suddenly change from getting gas from Russia to other parts of the world. You know, it's just energy is such one of those things that just takes so long to organise, to transport. It's not very quickly and easily done. We're still seeing that lack of workers, although, you know, when you look at the jobs available, I wonder if they're really accurate now. You know, some of those jobs may still be on offer, but the people may have already been placed in them, but the offers are still there. Or those jobs are no longer available. You know, I'm expecting to see jobs drop down on the offers, and I'm expecting people to start losing jobs soon. You know, I don't want to be a massive fear factor, but it's reality as far as I can see it. But just remember, this is my personal view. That earnings pressure still remaining there for the moment. But you know, as I say, I believe lots of countries, if not eventually the world, is going to head into a recession.